Welcome to today's Explainer. I am incredibly excited to dive into a topic that literally affects every single one of us, even if it usually operates entirely behind closed doors. Today, we're exploring the intricate, high-stakes guardrails that global regulators use to keep Wall Street's massive financial engines from melting down. We're looking at the heavy regulatory pressures in global markets and exactly how massive investment banks navigate systemic risks. If you've ever wondered what keeps the modern financial system from spinning out of control, well, you're in exactly the right place.
So what actually happens when a massive global bank fails? As you know, it's not just a bad day for a few traders. It is a full-on global domino effect. When institutions at the very top of the financial food chain stumble, the shockwaves hit Main Street instantly. We're talking frozen credit, destabilized businesses, and ultimately, real impacts on your personal economic survival. The global financial system is just so interconnected that a failure in one major hub can freeze up the entire grid. And that is the monumental risk regulators are up against every single day.
All right, here is our roadmap for today's Explainer. First, the global domino effect. Second, grading systemic danger. Third, taming material risk takers. And finally, number 4, the cost of misconduct. Let's get right into it. Section 1, grading systemic danger. This is all about monitoring massive scale.
Okay, so because these massive global banks generate revenues all over the planet, regulators absolutely have to keep a close eye on their scale and their potential to cause market disruption. They do this primarily using something called a GSIB score. That stands for Global Systemically Important Bank. It's calculated using a highly specific methodology developed by the Bank of International Settlements, and it evaluates an institution's potential to trigger a systemic financial crisis. Regulators use this exact score to determine the capital buffers a bank must hold. Basically, the higher the score, the more cash the bank has to keep locked in the vault as a shock absorber.
Now, you might be wondering, how exactly do regulators calculate this danger grade? Well, it comes down to 5 distinct categories. First up, size, simply how massive the institution is. Second, cross-jurisdictional activity, how widely their operations span across different countries and regulatory borders. Third is interconnectedness, meaning if this bank goes down, who are they dragging down with them? Fourth is substitutability. If this bank disappears tomorrow, can someone else easily step in, or does a critical piece of market infrastructure just vanish? And finally, complexity. How tangled and opaque are the financial instruments they trade? Every single one of these factors cranks up the danger level of a failure. Once regulators know exactly how dangerous a bank is, they force them to act. Think of these 3 steps kind of like the cooling rods in a nuclear reactor. Step 1. Banks have to conduct both mandatory and voluntary stress tests. They simulate massive economic disasters just to see what breaks. Step 2. They must integrate those results into their capital adequacy planning. This means making sure they have enough liquidity to survive those nightmare scenarios without needing a taxpayer bailout. And finally, step 3, they have to adjust their long-term corporate strategy based on those findings. It's this constant, rigorous cycle of preparing for the absolute worst-case scenario.
Moving on to Section 2, taming material risk takers. Now we're looking at regulating the human element.
Because look, systemic risk isn't just about abstract corporate structures and balance sheets, right? It's driven by human decisions made on the trading floor. Regulators have a very specific name for these individuals: material risk takers, or MRTs. These aren't definitely not your everyday bank tellers. These are employees whose direct actions have a material effect on the entity's overall risk exposure. We are talking about senior management, the people structuring massive credit products, those holding veto power on the trading book, or even just the top 10% highest paid staff in the whole organization. These are the people whose daily decisions can literally shift the needle on that massive GSIB score we just talked about.
Now, when we're talking about MRTs, regulators care a lot about how they get paid, and we have a clear contrast here between fixed and variable remuneration. Fixed pay is permanent, non-revocable, and based on professional experience, your standard salary. Regulators really don't worry too much about this. But variable remuneration, the bonuses, the stock options, this is where the regulatory magnifying glass comes out. Variable pay fluctuates with performance, and crucially, it can provide massive incentives for risk assumption. If an MRT knows they're going to get a multi-million-dollar bonus for a short-term win, they might take a reckless gamble that ultimately blows up the bank years later. Regulators scrutinize this heavily because unbalanced incentives are exactly what pave the road to financial crises.
To combat that temptation, banks implement malice or clawback provisions on variable pay. Think of these as emergency shutoff valves. They are explicit, ex-post risk adjustments. So, if a trader takes a massive reckless risk to secure a bonus, and that trade later blows up, a clawback provision allows the bank to literally reach into the trader's pocket and take that bonus back. It's brilliant because it ensures that material risk takers have skin in the game, not just for a quick win, but for the long-term survival of the institution.
And speaking of reckless risks, we really have to talk about what they're actually trading. Enter Level 3 assets. These are assets or liabilities whose fair value is measured using significant unobservable inputs. In plain English, these are financial products so complex or so illiquid that there is no active market price for them. You can't just go look up their value on a stock ticker. Traders actually have to use mathematical models to guess what they're worth. Because of this, banks mandate incredibly strict supervision, control, and validation policies over anyone pricing a Level 3 asset. These controls, combined with strict limits on proprietary trading, ensure a trader can't intentionally misprice assets just to artificially inflate their own performance and bag a bigger bonus.
Which brings us to Section 3, the cost of misconduct. What happens when the guardrails actually fail?
So what happens when these macro and micro fail-safes get bypassed? Well, the first line of defense is often from the inside. Regulators demand that banks maintain robust whistleblower policies. And I'm not talking about a dusty HR suggestion box. This involves comprehensive internal compliance programs, independent third-party hotlines where employees can report anonymously, actual financial incentives for reporting violations, and strictly documented corrective actions when a tip comes in. Maintaining professional integrity when you're dealing with billions of dollars requires an incredibly strong internal immune system to catch fraud before it becomes a systemic threat.
Because when they don't catch it internally, the results are completely catastrophic. Banks can suffer hundreds of millions in monetary losses from legal proceedings. We are talking about massive fines, huge settlements, and restitution associated with fraud, insider trading, anti-competitive behavior, and market manipulation. When an investment bank fails to manage its systemic risk or fails to tame its material risk takers, regulators and courts step in hard. The financial cost to the bank and its shareholders can be absolutely devastating. It is a literal, quantifiable measurement of the cost of bypassing the guardrails.
Which leaves us with one final, incredibly important question to ponder. Are these financial guardrails, the G-SIB stress tests, the compensation clawbacks, the strict compliance models, are they strong enough for the next global shock? Or have we just perfectly designed a system to survive the last one? Systemic risk management in global markets is an incredibly complex, constantly evolving battle. I really hope this explainer has given you a powerful new lens through which to view the daily headlines coming out of Wall Street and leaves you eager to dig deeper into the true stability of our global economy. Thanks for joining me, and keep questioning the systems that shape our world.